Hello and welcome to Forex.Academy, the #1 website for Forex and crypto education and analysis. In today's edition, we're going to be looking at technical indicators versus price action. The foundations of price action trading is based on the discipline of making all trading decisions based on chart analysis only. A chart relating to a specific period of time or time frames reflects the beliefs of traders in the form of price action. Technical traders believe that economic data and other global news events are the catalyst for price movement. Technical trading assumes that we do not need to fundamentally assess such data in order to trade the Forex market successfully. The reason for this is because that all economic data and related world news that causes price movement is ultimately reflected in the price seen on the chart. Here in example A, the candlestick formation shows an elevated price action at the beginning of the chart on the left-hand side. It then falls lower, and traders believe that market news is in the price, and therefore they are safe to trade the charts on the basis that their technical indicators are telling them that price action is overbought or oversold, and therefore their chart indicators have a greater probability of offering winning trade setups until the next release of economic data, including such things as unemployment, CPI and inflation, gross domestic product or GDP, interest rate changes, and political events and conflicts. How do we analyze the price action? Let's look at example B. This is a 15-minute time frame chart of the Euro-USD pair. Each of these Japanese candlesticks present 15 minutes of price action. Traders always read their charts from left to right, and in this case of Japanese candlestick trading, they try to decipher the meaning of each candlestick, either individually or as part of a trend. In example C, we have highlighted some gravestone dojis and inverted hammers, which traders look out for because they tend to occur at times of price action slowing just before a reversal. In example D, this is made much clearer by the use of some technical lines to identify an ABCD price action, and where at position C, technical traders would be looking for a push lower to the D position purely based on the gravestone and inverted hammer candlestick formations. Now let's look at example E. We have added a trend line at position 1, and we can see a clear trend which is moving to the upside. Price action bounces off our trend line as it gradually pulls back from the lows to the previous ABCD price swing. However, price action begins to flatten out at position 2, and when price breaks through our trend line at position 3, our bear traders will no doubt be wondering if there is going to be a continual push lower to add to the overall trend of this chart. The push lower is short-lived and the price reverses during position 4, and where this 3 candlestick formation is known as 3 bullish soldiers and typically denotes a strong bullish trend. Price action falters at position 5, and this becomes an area of resistance or a ceiling, because technical traders will have drawn a trend line, such as ours, and noted that the price failed to go above this level on 3 previous occasions at position 2. Indeed, price action begins to fall lower from position 5. So, in these examples, we can see just how important price action alone, in the form of Japanese candlesticks and a few lines drawn onto our charts, can be so effective in analyzing the clean price of an exchange rate. There is an abundance of information when we drill down and look for it. But this can only be truly established by learning about how Japanese candlesticks can define price movements, the stalling and reversal of price movement, and the indisputable evidence that they provide of support and resistance on the basis that these candlestick shapes and formations simply repeat themselves time after time. Price action is a leading indicator, whereas technical traders, which are overlaid onto charts and follow a statistic measurement of price, are lagging indicators. While technical indicators are an extremely effective tool on technical analysis, they often throw up false signals or simply lag behind price action, sometimes to the point where they become unreliable when used on their own and without factoring in price action. Here at Forex.Academy, we recommend that new traders learn about the significance of Japanese candlesticks and study their charts. Always read them from left to right because they tell a story of where price action has been and where it is likely to move in future, based on the fact that all relevant fundamental data is already encapsulated in the exchange rate of a particular price action. If you enjoyed the video, please like and subscribe, and comment down below if there's anything you'd like us to cover in future, or if you would like to discuss the topics we have covered. Have a great day.